began this initiative 18 months ago, and we're very pleased to be distributing every 60 days in partnership with Merrill Data Site our best practices installments to over 500,000 M&A professionals. We expanded into the UK and European market with Merrill last year. And as I mentioned earlier, later in the spring of this year, we'll be publishing in Portuguese, Russian, and Mandarin. This is the best practices, the best deal makers, the hardcover edition. If you don't have it already, there are some at the front. If we run out, we're always pleased to send one to you. And today, I'm very pleased to welcome Mark Sirower, who will be hosting I think a very thought-provoking and informative session together with our esteemed panel members. But I'd like to begin by introducing Pavle from Sabic from S&P Capital IQ. S&P Capital IQ has been a very trusted resource and partner with the M&A Advisor for the last couple of years. And I think Pavle is looking forward to being able to share with you some of the developments at S&P Capital IQ that they believe can be of great value to the restructuring community. Pavle, welcome. Thank you.
Good morning, everybody. You can probably guess that I'm not Thomas Yeagle, as you can see from the agenda. But the similitude between the two of us is that we both do work for S&P Capital IQ. And so I'm very pleased to be here just before this esteemed panel to just talk about S&P Capital IQ and where we're going. But to understand where we're going, we have to look at the past. And how we were created was to look at the Capital IQ platform, which I'm sure many of you are familiar with, and also the legacy, which is the S&P side of things. So it was really the breadth and the history of the credit combined with the innovative, limber kind of astute company, which is Capital IQ, and bring these two together. And what does that mean? That we had the credit at our disposal, but also the news and the information all together so that we can help the restructuring community, we can help the distressed debt community. And one thing I want to talk about very, very briefly is what we're seeing a lot with our clients time and time and time again. And that's really that time is critical and they want things done as soon as possible, particularly when it comes to identifying any sort of distressed debt. And every sort of institution has their own way of looking at how debt becomes, or turns into distress. Whether it's looking at the employee turnaround, whether it's looking at earnings announcements decreasing over 2 quarters, whether it's maybe an outlook from S&P ratings, whether it's the equity price dropping and the probability of default increasing. These kind of things all have to come together for a holistic view ahead of time so that you can actually be the first one to get into this kind of deal. And we're finding that more and more, and we're finding that our clients like to customize these views so they can look at the qualitative with the quantitative, look at the company specific, and not only here, but cross-border as well, which becomes very difficult when you're looking at restructuring, when you're looking at the distressed debt over there, because distressed debt and defaults are very, very different across the board. In London and Europe, they're not the same as they are over here in the States. So these specific industry and country aspects that come into play are very, very important and things that we are developing as well. Now with that, what I want to do is hand over to Mark Sirower. But the main message that I want to come across before I do that is the fact that time is critical, and what we're trying to do is save our clients time, which is the most precious commodity that we all have. So considering that time is of the essence, I'm going to hand over to Mark so you can introduce the panel. Thank you.
Hi everyone, good morning. Well, I'm going to have to liven this up. This isn't a good Good morning everyone.
Good morning.
All right. I'm Mark Sirower. I'm with Monitor Deloitte. I lead their M&A strategy commercial diligence practice, and I do a lot of pre-distress strategy work. Well, the panel today is called Best Practices. By the way, I'm just still learning how to use reading glasses. I got to use them all the time, and I'm very uncomfortable with them. So about 10 years ago, I was in an airport, and I had the newspaper out about like this, and a woman about 80-something years old leans over to me and says, "It's time." And well, it finally is time. But this is the best practices of the best restructuring deal makers. And we've got 3 panelists with us today. I'm going to do brief introductions, and we're going to launch right into it. First on my left is Peter Kaufman. Peter is the president at Gordian Group. He's been at Gordian Group since 1990. He was founding co-chairman of the Committee on Investment Banking at the American Bankruptcy Institute. He is co-author of the definitive work in the field, Distressed Investment Banking to the Abyss and Back. Mr. Kaufman has also been profiled at The Deal, where he's consistently ranked as one of the 10 leading national investment bankers in financial restructurings. He is national TV's go-to authority for restructuring and bankruptcy reviews. Prior to joining Gordian Group, Peter was you don't mind if I call you Peter? All right. Peter was a founding member of the First Boston Corporation's Distressed Securities Group. He's got over 25 years of experience solving complex financial challenges. He's a BA in history and art history from Yale, where he played lacrosse. And I was funny when I was reading your bio. I remember I did a little swimming in high school, but I never played varsity lacrosse at Yale. And he has a JD from University of Virginia Law School. To his left is Lorie Beers. Lorie is a senior managing director at Variant Capital Advisors, where she has a leadership role in the investment banking practice and its activities, including M&A, capital raising, balance sheet restructuring. Ms. Beers has more than a dozen years of investment banking experience and 20-plus years of corporate restructuring and insolvency transaction experience. She's familiar with a wide range of industries and has driven both in-court and out-of-court restructuring success, and is credited with developing the complex financial restructuring program for the American Bankruptcy Institute. Prior to joining Variant Capital, Lorie was a managing director and global co-head of investment banking at Seabury Group in New York, where she was responsible for Seabury's middle market and aerospace investment banking practice. Prior to that, she established KPMG's Special Situations East Coast practice, and has spent several years practicing law in a number of East Coast law firms. And Lorie went to the University of Pittsburgh Law School for a JD and a bachelor's from Dickinson. And finally, to her left is Deirdre McGuiness. Deirdre is a managing director at Kutzman, Carson Consultants. As a managing director, corporate restructuring services, Deirdre leads growth initiatives and maintains relationships with KCC's list of clients. Deirdre joined KCC with more than 25 years of legal experience. She most recently served as the managing director for Wells Fargo Capital Finance in New York, focusing on distressed lending and expertise in providing financing solutions for companies facing challenges. Deirdre served as a United States trustee and oversaw the administration of the largest and most complex Chapter 11 restructurings, including Delphi Corporation, Delta Airlines, Dana Corporation, Northwest Airlines, Refco, Calpine Corporations, and St. Vincent's Medical Center. An active member in industry organizations, Deirdre currently serves on the strategic planning committees for both the Southern and Eastern District of New York bankruptcy courts. She has a JD from Quinnipiac University School of Law and a bachelor's from NYU. And she's also an adjunct professor of law at St. John's. So we have a very distinguished panel today with a lot of experience. And I'm going to launch right in. I'm going to mix this up a little bit, but just so you get a sense of the theme that I want to try to follow, I'm going to ask some very kind of general questions just to kind of get the panel talking. And then I'm actually going to open up for a little sort of interim Q&A. So we're going to do this together, and then we're going to go back to my theme, which is going to be positioning for the transaction, value creation inside the transaction, and positioning for exit. All right, so let's do it. We've got, how much time do we have, Zoe? About 45 minutes? 40?
Well, the bios took like a half hour.
No, it was 5 minutes. I rehearsed it down. It was 4 minutes and 30 seconds. Okay, but they had to know who we were talking with. All right, so I'll just kick it off. Well, I'll let you time when you're tired, and we'll go from there. Okay, so I was at a Columbia conference recently on private equity and distressed investing, and one of the speakers described the distressed investing environment as follows: cheap money, leverage, increased M&A activity, and a deterioration in financial discipline. His general sentiment was that opportunities for distressed investors exist, but the degree of difficulty is high. All right, so here's my question. With so much capital chasing distressed deals now, I mean, and it's been increasing over the past several years, what do you say to your clients to maintain your walkaway standards from deals? That is, where or how might best practices, in the way you see it, how might best practices be suffering in light of all the competition that's chasing deals now? And are you advising your clients to act differently on either side of the transaction? Also, as you address this, and I'll let you go kind of, Peter, Lorie, and Deirdre, if you take a couple of minutes on this, just to kind of talk about the environment and the way you see it and how our best practices shifting in light of this competition. If you could also, in your remarks, indicate what industry sectors you see substantial opportunities in the work that you do, and what do you think are the factors that are driving those opportunities in those industries? Okay. Peter, I'll let you kick it off.
Well, I'm sorry?
There's a lot of questions. Yeah, it's a big
No,
question.
it's, there's a lot of competition. Where do you see the opportunities and what's driving them?
Well, we don't advise investors in distress very often. We'll do buy-side M&A if somebody actually has a target they want to go after. Personally, I advise boards of directors, old equity, in troubled situations, and the environment over the last couple of years, which seems to be ongoing this year, is that if you are financially distressed and you can't find new money, then you're really not the best student in the class. Mm-hmm. And particularly when we're talking and advising private equity firms, which we do a lot, if they don't have the best student in the class, they've got to do something that they really don't want to do. They've got to take some action and deal with their creditors, because most private equity firms, if they're hitting a maturity wall and they can't find the cheap money, the easy money to refinance out, they're usually still believers in their operations. Now, if you say, well, you've had 5 or 7 years to get it done, and but you just need a couple more years, you might raise an eyebrow, but they're the client, that's what they believe, so the mission is usually to try and extend out the debt wall. And our mission, when they task us with that, is to, notwithstanding the lack of available capital, is to figure out how to go to those creditors. We like to do it with carrots and sticks to encourage them to do what the private equity firm wants, which is to kick out the maturity wall. How we do that depends, every situation's different, but we like to have, everybody measures their outcome against a bankruptcy. Nobody ever wakes up in the morning and says, golly, I'd like to go into bankruptcy, unless it's the bankruptcy lawyers. But certainly private equity firms don't like to do that unless they really have to. But everybody around the table measures what you're offering to negotiate with how they will do or you will do in a bankruptcy setting. So you've got to go to them with well thought out, credible sticks about what you think you can do to them in a bankruptcy setting, and that, hopefully, if you do that adroitly, hopefully leads to something favorably consensual, to your client in an out-of-court restructuring.
Got it. Any particular industries where you're seeing significant or more opportunity?
Manufacturing, healthcare; those are two that that come to mind.
Great. Lorie?
Like Peter, we typically advise on the sell side and represent companies, but we have engaged recently in a few buy-side campaigns for private equity. And to your question, Mark, I think the issue is putting discipline around the investing process. There is so much liquidity out there. It's easy to get caught up in the fervor of the situation, and people often find themselves in an overbidding situation where they're investing more than they had originally intended. And we work with clients at the outset to sort of set the boundaries and the curbs around where their investment is going to go, and encourage them not to let the fact that there's so much money out there and so much competition for every deal to take their eye off the ball in terms of what the investing opportunity really is. We've had a couple of private equity clients who have gotten ahead of their skis on these types of situations and really have ultimately ended up in the situation that Peter just described, which is trying to do an operational workout as well as a financial workout, which is pretty tough. In terms of industries, I think there are a couple of industries that are peaking and are on sort of the back half of this downward slide, and I think that healthcare is one, food and ag is also, we're seeing a lot of opportunity in that space. Automotive, aerospace, and defense are sort of cresting the curve, and I think we'll be seeing more opportunities in those arenas as well.
What sort of factors do you think at the industry level are driving some of those? Take the ag, food and ag.
Well, there's been a big shift in sort of the way the consumer is looking at protein. So there's a lot of excess capacity in the market. So there's a need for consolidation. It's a less attractive opportunity for many investors. So there seems to be a shift away from that. So I think that there will be more distressed opportunities in that arena.
Got it. Okay. Thanks. Deirdre?
Like Peter and Lorie, I don't advise clients on direct distressed investing. But when I was a banker, I always looked at the potential borrower as my client. And the notion of best practices, I think, really dovetails with the situation that's presented in the market, right? Because best practices in 2008 are not the same best practices in 2014. As a banker, I would say, best practices kind of shift. When I was doing the Abitibi-Bowater exit facility, we struggled to raise $300 million. Struggled. And now, my last deal as a banker was the Hawker Beechcraft exit, which was oversubscribed by 6 times. So that is a ginormous shift in the market. And, the availability of financing, to Peter's point, any management team, any board that has not revamped their capital structure in the last 4 years should be fired. I mean, it's really that profound. If you look at the financings that are going on in the market today, we're going right back to where we were pre-dislocation. Covenant light. When Pavle was,
Bank said they would never do again.
Never.
No
Oh my
more covenant
God,
light.
we're never doing this again. And I think Pavle mentioned defaults in the United States, defaults in Europe. I haven't seen a default in I don't know how long, because the banks are incentivized for a fee to give some sort of relief, and it's very rare that you see a bank putting down the gauntlet and saying, okay, you're in default, all hell's breaking loose. And whether distressed investors are chasing deals, advisors are chasing deals, money center banks are also chasing deals, and the competition is savage for the fee pile, so to speak. So my notion of best practices is not a stick in the sand. It's something that always evolves. Now, being at KCC, which is a claims bankruptcy administrative services platform, when I tell you the industries that I think are hot, please don't look into it more than just the statement. Anything that has to do with paper. I have 3 kids in college and 1 on the way, and they're never going to buy a textbook. So anything to do with print, envelopes, yellow pages, anything to do with paper, I believe is an industry in decline. Coal is something that is on everyone's radar. Shipping should be on people's radar as day rates fluctuate, as fleets are percentages of fleets are left idle and not moving and carrying cargo. That's something to look at. I'm amazed that we have not seen more healthcare. Maybe it's a function of what's happening in the administration right now, but I think that's something that's definitely coming down the pike, and everyone should be ready for another wave of healthcare.
Wow.
And I think in healthcare, it's not just going to be the providers. I think we're going to see a lot in healthcare services and products as well as providers.
What's
and
Radiology, sonograms, because physicians groups have exploded in growth to chase revenue, and I don't think that's sustainable.
And we're working on a couple troubled hospitals. This country is overbedded. The whole paradigm is shifting because of Obamacare, and whereas the spigot used to be turned on to an unlimited amount or more, that's dramatically changing and shifting, and that's great for our business, right? We like dislocation and change. That's not always good for other people, but it's very good for us.
Yeah, understand.
The one other thing I'd like to add is that aside from the Madoff type situation, we haven't really had a good old-fashioned fraud case in a while. And we know it's out there, criminality is human nature. We're just waiting for it to be uncovered. But we need a couple of those.
Yeah, this is great. Since we're sort of talking about the macro level, Deirdre, one other question I had for you, and we were talking about this last week when we talked on the phone. In this interest rate environment, if rates were to tick up slightly, would there be any effect on distressed M&A transactions?
Oh, I think there would be a huge effect. I mean, just maybe a 100 basis point swing, because thankfully in restructuring we can always count on failed operations, not so competent management, declining industries, and because you can, if you're a constant issuer in the capital markets, yes, you're always going to be able to get liquidity, always, because you're paying the street fees. Right, so there's reciprocity there. There may be some issues, but banks can underwrite over or around those issues. But I think once the cost of capital starts to increase just a tiny bit, I think it's going to have a huge effect on the companies that have to go into Chapter 11, because their banks have to roll into the facility to fund the Chapter 11.
Well, you're awfully cynical for someone so young, Deirdre, I have to say.
No, Peter, I'm going to look like this forever.
Yeah, the low interest rate environment is clearly, obviously, fueling the easy money, but I think what has to change is either rates go up, and it's still unclear to me what's going to make that happen anytime soon, or the credit markets, the refinancing markets need to have a hiccup, freeze a little bit, and I don't think anybody here is smart enough to know how or when or why that will happen, but certainly exogenous forces outside this country, war, for example, could certainly bring that. But I think as we sit here today, the easy money, the refinancing money continues to flow, and that's an invitation to later disasters, but not really current ones.
Got it. All right. Thank you. Okay. So let me offer a hypothetical case of a company, once very successful furniture company. It's called the Foremost Furniture Company. Desmond Gruntle is the CEO. He founded the company 45 years ago in Plum Valley, North Carolina. After decades of success and great holiday parties with all the close family members who grew up in this successful business, Foremost has had declining sales and simply can't compete on price versus cheaper imports. How do you approach a domestic business that is becoming obsolete because of global competition? It just can't compete in its current form. It will be extremely tough to make the business cost competitive. What are some of the best practices in saving this business? So what are some of the alternatives for that business?
Are you talking?
This to everybody.
Are you talking operationally?
Yeah, you've been called. You've been called for advice from. What are some of the things I can do to save this business?
Well, it sounds to me that this furniture company is a family-owned business. It's a private business, and having banked several of them, they're very, very difficult because they don't fire anybody anytime. So I think the first thing would be to look at management, maybe get someone from, like Kelly from Alvarez and Marcel to come in and give them some, or that's right, Kaufman McKenzie, or a number of firms to just be a sounding board, be a scapegoat, be the bad guy, to come in and give them a little, what they say, come to Jesus chat, and then look at the capital structure, see if refinance or recapitalization can be achieved, and then start what we call the nickel counting, getting the supply chain, the cost cutting, the vendors, really start honing in on centralizing and looking at efficiencies.
But in a business that's obsolescing, I mean, the end game is ultimately you've got to sell it before it becomes completely obsolete. So
Their cost structure is double what their Chinese competitors are. You can fire everybody, and they still can't make the. I'm just adding to the fuel of the fire.
well, there's some private equity guy that's going to buy them.
Okay.
There's some distressed investor who thinks that they've built a better mousetrap, and so the answer is to, before the business is completely down the toilet, is to position it to best capture the value that's remaining.
Okay.
Well, you can't really know what to do until, forget about a consultation. You need a chief restructuring officer that the family gives plenary authority to come up with a new business plan, to deal with the expense structure. And when the dust settles on that exercise, which needs to happen very quickly, then you can have a view about what's an appropriate capital structure. Do you get your creditors to, swap debt for equity? Is there a business plan, a credible business plan that the professionals and the family think is workable and that they can make money on and attract capital for? So you can't really know if you've got to do an emergency sale to somebody until you've gone through that exercise, and that of course assumes that you've got the liquidity to bridge to a 6-week exercise for a CRO to come in and try and create a set of projections that people think have reasonable assumptions, and then around that you figure out what's the capital structure look like, what does an M&A look like, and you try and create options and optionality. What's a self-help plan of attack that this furniture company can do? What do they need from the outside world, et cetera? But it all starts with, as Deirdre said, you talk about private businesses, privately owned family businesses, and they got the kids' bar mitzvah in the expenses and everything else. You got to strip all that out and figure out how to retool the operations from a cold-eyed view of the world before you know what you've really got.
I agree with that, but at the end of the day, it's a business that is not going to exist. It's like the textile business in this country. There is no room for it at the end of the day. So the two choices are: the family can run it out to the end and literally spend their last nickel, or they can try to capture value while value remains. And I'm not suggesting that you run an expedited sale process, but at the end of the day, if there's any value to be had, that's where they're going to capture it.
Right, but the best practices for something like that, in my view, are even if you're going to run an M&A process, you want to have a self-help restructuring plan foil, so that you can try and keep buyers honest, that if they try and come in too cheaply, that you'll have something viable and credible to do on a self-help reorganization basis. So, I agree. If you made up these assumptions that it's a business that's DOA.
This is a case that I worked on in pre-distress. Someone was looking to acquire it, and we did a diligence, and they're toast. That's why, Lorie, I think you hit it right on the head. This is exactly what you start to see when you dig into what the cost curve, what the global cost curve is for that.
But I do agree with Peter. Having a plan B is important. I rarely agree with Peter, but on this instance, I do agree with Peter that having a plan B is important, because oftentimes you get into an M&A process and it's not as robust as you like, and you need something to compete against the only buyer who's in the room. So having a credible plan B is critical to making sure that you can at least create the appearance of a robust dynamic.
Right. So who are the potential buyers for this kind of asset? It's got a well-known brand. But it's just a business that's just not cost.
Well, I think some of the answer is in your hypothetical, which is some of these foreign buyers are now looking for a U.S. toehold, and they like branded alternatives. So if there really is value in the brand, selling to somebody down the supply chain may be an alternative. Selling to a foreign buyer may be an alternative. And clearly there's a bunch of distressed investors in the room who may look at that as a strategy if they can fix the business and do an operational turnaround. So I think that there is a universe of both financial and strategic buyers that might be interested in that opportunity.
Right. Excellent. Okay. Peter, you sort of brought it up, but how do you tell a management like, Desmond Grunthal, who founded and ran the business for 45 years, that Des and his family are just not the right team anymore? How do you have that conversation with management?
Well, the first option is to have somebody else have that conversation with them. I really like to have the market tell boards and management, what the story is, but you come in there and say, here are the facts. Here's what you're doing operationally. Here's how we would value that based on comparable company trading multiples, M&A comps. You're in big trouble, and the way you've been doing business no longer works. Before I have that conversation, I want to make sure I've got a good tail on my contract. Well, this is a tough crowd. That was funny.
I laughed.
I can go.
And then you've got to be honest with them in a palatable way. You've got to explain, if you do X, Y, and Z, that's your best chance for salvaging the family name, making sure Junior might still have a job, helping whatever employees you don't have to fire remain in the North Carolina community. So you've got to be candid, but you've got to give advice, and that's one of the fun things about our business. You have to give advice in a way that people will actually consider it and hopefully take it and run with it. If you go in there, just saying, obviously you're a dumbass and you've run this thing into the ground, now we think you ought to do this. Yeah. You've lost before you have the chance to give what hopefully is good and prudent advice.
In my experience, I've seen advisors go in for a very short period of time, 3 months, 6 months, because that's all the company wants to pay for. And then the advisors go home and go do their thing, and the company takes all the recommendations, but they can't implement. They just can't pull the trigger. So they wait another 6 months, and then they say, wait a minute, can you come back? We can't have these hard conversations with the head of operations or the different management direct lines of reporting. So it takes a while, and maybe that first set of advisors get not rehired and they hire another set, but they're all saying the same story. And so to be really, really effective, you got to hope that some guy before you got fired and that now the advice really resonates. And if it's a family-run business, they do care about the family. They do care about the kids, the grandkids. They do have pride in their product and in their company, and they do want to see it survive, not just for them, but for their legacy. And so they're hard conversations to have, but it eventually sinks in.
Got it. Okay, thank you. So let's move on. Let's talk about corporate governance a little bit. When we talk about distressed investing, corporate governance is often front and center with issues like risk shifting and decision making from shareholders to bondholders, the many stakeholders in the debt where there may be many more players than the original lenders. What advice do you give a board so that they just do the right thing?
Do the right thing.
Do the right thing.
Well, this is a several-hour discussion.
Well,
boards should not cede, no matter what their they should never cede authority for their decisions to their creditors. One of the axioms that we at Gordian live by is, we don't do bondholder side representation so that we can give a board unconflicted, aggressive, hopefully creative advice about how to get their creditors to do what they want them to do. And until you're not the board, you are the board. And so you make decisions. You've got good lawyers explaining what your fiduciary obligations are. Now the pool of folks to whom you owe fiduciary obligations has expanded from your shareholders to include your creditors. That's not legal advice. That's my understanding of how it works. But within that, there's a whole lot of running room that a board has to take action, develop strategic plans, and go to their creditors and shareholders with various restructuring plans. And there's a lot of wiggle room, a lot of gray area. If they're getting, advice from reputable professionals that they can hide behind, boards, as long as they discuss things, they frequently have meetings, they have discussions, they make informed decisions. That's a good way for boards to stay protected. But you don't turn over to the decision making to the loud people storming the castle because they bought a claim for 8 cents and claiming you owe them 100 cents,
Right,
and
right.
you should do what they want you to do.
But it gets more complex, Peter, when the fox gets in the hen house, where the bondholders, as a condition to floating the bond, are insist on a seat on the board. So now you've got the fox in the hen house, and they're maybe not acting in their own best interest. And I think the solution to that, the best practices, is for is to get an outside director and make sure that you've got outside representation that is not representative of just equity and the shareholders and or the bondholders or anybody else in the capital structure, that you've got unconflicted outside advice that can insulate the board from those types of claims.
So maybe I've just been lucky. I've never once been stuck with a bondholder on a client's board of directors. What I do have a lot, and to your good point, independent directors, and those become terribly important. And the most important thing about them is you don't want to lose them. They come on, usually, the life cycle is they come on when things are healthy, they're getting some nice benefits, they play golf with the CEO, whatever, and all of a sudden
They don't want the shitstorm.
there's a shitstorm. And so you've got to make sure that the care and feeding of the independents takes place on a very regular basis, and that you explain to them, with the help of lawyers, that if they resign before there's a solution implemented, they're in a lot more risk than if they stay the course to see it through to a solution, hopefully a consensual solution, hopefully one where there are releases, but you can't lose the independence. But you don't let the fox into the chicken coop by letting bondholders sit on boards if you can possibly help it, and I've been able to help that. But the independence, if you lose them, the game's really over.
So let me ask another, this is to Peter and Lorie. How important is the independence of an investment bank when clients are selecting an advisor?
Well, I think it's critical. I think that
Paramount.
you can't be beholden to a particular type of constituent if you're representing the company. And there are folks who represent creditors and there are folks who represent bondholders. I think they're poor choices for company side work, because their regular bread and butter comes from a particular constituency, and they're not going to want to piss them off.
And also, if you have to avail yourselves of the protections of Title 11, then you have to be retained by an order of the bankruptcy court, and the code has very specific criteria for retention. And so if you're not disinterested, it's a dead stop. And so why would you even bother go down that road? Unless you were, there was no conflict whatsoever.
Well, there are a lot of really smart, clever people in our business, and so I associate myself with Lorie's comments about the need for an independent bank. But what you'll hear from someone who works both sides of the street is they'll go to the board when they're being interviewed and say, "Oh, you know what? We're really tight with these bondholders. That helps you because we know what's going to help get a deal done, et cetera, et cetera." Whereas if I'm talking to the board, I'm going to tell them, I'm ready, willing, and able to cut their heart out for your benefit because I don't solicit them for business and I don't get hired by them. And so, we all know what we think the right thing is, but people who are playing both sides of the street can sing a siren song, and the really stupid boards are the ones that buy that.
Got it. All right. Let me move into some specific kind of deal-making type question. The first is for Deirdre. What are the key considerations in underwriting distressed M&A transactions out of court, but also in Chapter 11? And how do those considerations change as you're moving from out of court into Chapter 11?
Well, I think the out-of-court solutions obviously are a lot more. They're a little easier. You can be a little bit more creative, a little bit more flexible. But once you're in Chapter 11 and you're putting, a DIP facility together or a DIP to exit facility together, I think the key considerations are obviously the code demands that you shop your financing, which of course everybody does. And by shopping these days, it's not exactly staple financing, but the investment bankers who are advising the company will ask for term sheets from 5 or 6 institutions and cherry pick the terms that they like, marry it all together into a term sheet, disseminate it back to the banks and say, okay, which one of you are going to underwrite this facility? Which one of you are going to lead it? Now, there's efficiencies there, definitely, but it really comes down to underwriting strength. Money center banks make money because they deploy money, they like to make fees, but you have to take risk and you have to underwrite the facility and take the syndication risk. So, a Goldman Sachs, a JP Morgan, they have big pens, they're gonna write big checks, and if they get hung on a deal and they don't syndicate it to the last penny, they're fine with that. Smaller regional banks, they can't do that. They get hung for $50 million and that could crush them. So it's real, it's of scale. But those are kind of the key considerations, making sure there's an effective, fair, efficient process at the best, lowest price point and cost of capital for the borrower. But because of the demands of the bankruptcy code, it's a little tougher when you've got a lot of eyes looking at you and reviewing what you're doing. Whereas, the out-of-court solution, you have a handful of, the table-pounding bondholders. I think bondholders get a bad rap, by the way. And so you can be a little bit more nimble outside of court than you can within Chapter 11.
Got it. Thank you. We'll come back here to Sir Peter and Lorie. What are some of the best practices in advising your clients of how to look or how to assess the risk of a potential distressed asset versus the more traditional type investments, especially when it comes to thinking about the return you're going to get on that asset? In other words, what sort of characteristics are you looking at that might help you tell the difference between a good one and a good risk return trade-off for a distressed asset versus a bad one?
Well, if you're advising a potential acquirer of a troubled company, you've got to start with, what do I think I can do with this business? Am I grafting it onto an existing platform, and how do those synergies look? Or is this going to be a standalone investment? But either way, you want to have a pretty crisp view to the best information available, because we all work in a world of imperfect timing and imperfect information, and figure out what returns you think you can make 3, 5, 10 years down the road, depending what your time frame is, and you back into that what price you're willing to pay today. On the other hand, sometimes, particularly in the venture capital or technology area, a financial model can be tossed out the window. You either love the technology and love the market that it's in, or the market that you think is coming, that technology, and it doesn't matter if you pay $8 million, $10 million, or $25 million for that asset. You want to have it because you're a bull on the big picture. So I think it really depends on what industry it's in, what your rate of return goals are, and how much do you love the business, or at least the technology and intellectual property, depending on what the case may be.
I think you also have to bake in sort of the risk of a distressed asset. I mean, you have less time, less due diligence, and less opportunity to fully vet where this is going versus a regular way M&A. So you really want to make sure that you're assigning the right degree of risk to your return based on all the factors that are available. And the transactions move much faster. Right. I mean, a regular way M&A transaction can take a year to, from start to finish, whereas a distressed sale often happens in, 60, 90 days. So the degree of information and the imperfection of the information has to be taken into account as you're evaluating a distressed opportunity.
Are there any big red flags that you look for if you got 5 potential transactions. You're advising a client that wants to do, as a buyer, you got some potential transactions in front of you. Any sort of really well-known warning signs, red flags that would?
You know, it's really situational, Mark, because in some cases there are folks, for example, there are folks who will stay absolutely away from any, in the healthcare side, from any reimbursement-related opportunities, because they view the potential change, external change in legislation to be, you know, too great. There are other people who think that that's a hotbed of opportunity and are looking at those businesses, you know, all day long. So it's really situational. I don't think there's a particular red flag. I think it has to do with the appetite of the investor, and, you know, the particular sectors they know and want to be in.
Gotcha. So I actually lied about opening this up for Q&A earlier. The time's gone so fast. I have a few more questions I want to ask, and hopefully we'll have like 5 minutes for Q&A. So before I do open it up, a couple things. Again, this is best practices for the best deal makers. Are there any particular ways, Peter and Lorie, that you position your clients best for winning a deal?
Well,
particularly in multiple bidder environments. I guess
sure,
that's what I'm really got.
sure.
Are there intangibles that you get them to try to offer?
You want to figure out how to game the system. So I'll give you a specific example. We were advising a buyer of a learning company, and the hooked on phonics.
Okay.
And it was 1-800-ABCDEFG was the phone number. Well, our due diligence revealed that the company licensed that phone number from the owner-founder. So we had our principal go cozy up, get friendly with the owner-founder, and he then licensed that phone number upon to our client. So if somebody else didn't win it, somebody else won it, we were going to have that phone number. And we knew that was going to cause a shitstorm. I'm sorry, that's a New York term of art.
We call it a shit show in my business, but I like shitstorm.
Once the creditors and the court found out about it, but it froze people against the boards for about 2 weeks. And meanwhile, the company was running out of money. They couldn't off-put the auction. And by the time the auction came, we were about the only ones ready to make the acquisition. And so the judge made us walk from that license agreement before the auction, but the damage to everybody else had been done. We won the auction because we'd come up with something in that particular situation that worked well to hip check other bidders into the board. So that's one example that comes to mind.
I think also underscoring the synergies of the business as you're thinking about acquiring the asset, how you're going to deal with management. Lots of in the example you gave earlier, in a generational sale or family-owned businesses, the seller wants to know that their people are going to be taken care of. That may be the paramount importance. So it's important to understand what the seller's objectives are as you're going into the auction, and make sure that you're not only gaming the system, but you're addressing the legitimate business concerns of the seller, which will position you better. Because in bankruptcy, it's higher and best, not just higher.
Right.
So you can be the highest bidder, but the qualitative aspects of the bid will come into consideration, and it's important that you are making sure that you hit all of the key concerns of the seller.
But the fun part of this business is there's nothing cookie cutter about the problems. There's nothing cookie cutter about solutions. I love this business because it's, I go to war and I play games in each situation, and it's complete. Everything's different. There's no markup the last deal, and so. Right. That's what's fun about it.
So I have just a couple of things, and this is to you, Deirdre. You were a U.S. bankruptcy trustee in the Southern District, some big cases, and so you know a lot about the administrative burden on companies. Can you talk a little bit about what potential investors need to understand, what they're going to have to contend with and be prepared for?
Well, Mark, are you talking about just administrative burden as far as delay, costs?
Just things they need to be, just some basic things that if you're distressed investing and you're looking at a company in distress or in bankruptcy.
Don't ask for an adjournment of the auction.
Yeah, don't ask for an adjournment. I really leave it up to not so much the investment bankers or the corporate bankers, but the lawyers to really advise the investor that once you go into this arena, there's parts of it that are in your control, but there's large parts of it that are out of your control. Right. And distressed investors don't have, in my experience, an abundance of patience. And they want everything to happen now, yesterday. And sometimes, the court just cannot accommodate their schedule. So there has to be a little bit of patience woven into the transaction. And also I think the lawyers have to really quantify the risk that they may not win. And if you don't win, you still have to pay. And that never goes over well.
Great, thank you. So we have time for a couple questions. I see this woman has been waiting.
I'd like to ask the panel, when and what would you have advised Dewey LaBeouf to have done about their situation?
Not cook the books?
Well,
cook the books early.
I think they overpromised and underdelivered. So I think when you recruit and you give very, very competent, talented people compensation guarantees for multi-year contracts, and you do it to a lot of those talented people, and the revenue doesn't support that, then things are gonna start to crater, and it's gonna become Lord of the Flies very, very quickly.
They forgot to invite you in.
It's very hard for professional service firms to manage through a distress process. It's almost impossible because your assets are your talent, and talent will flee at the first instance that things are, a little bit on the skids. So it's very, very difficult to. I'm not sure that, obviously you shouldn't engage in any kind of criminality or that sort of thing. But I think the issue is really the firms who have survived are those who have found merger partners early and not waited until the 11th hour. And because if the talent leaves, you're done.
So I'm involved in an unnamed law firm debacle, and each of these situations, like everything else, is different. Sometimes there's a mismatch between revenues and expenses. It can be a firm that is predicated on contingency plaintiff work, right? And those very lumpy, the timing's unpredictable, but you've got these expenses and contracts. So you need to borrow money, but you need to be very honest with your lenders. Dewey was a different situation. But the mismatch between revenues and expenses and needing to fund the difference is critical, and it can snowball very quickly because people can hit the exits with pretty much impunity.
And most of you know that the margins in professional services, law firms in particular, are not down here with the ant army of associates, right? Because that's what's get written off the most. It's the senior guys that are the rainmakers that are really bringing in the clients. That's where the margins really lie. Yeah.
Can I ask a last question? I'll let you answer one or two questions. The one is, do you see any innovations, either around financing, coming down the pike? Do you see anything emerging in doing distressed deals? The other one is on the regulatory side. Do you see any around bankruptcy, any sort of regulatory changes or legal changes happening over the next?
Well, I found the Judge Gross's opinion in the Fisker case as a debtor side guy to be incredibly pleasing and hopefully earth-shattering when distressed investor paid X cents on the dollar for a bank claim and piously showed up, as they always do, saying we're owed 100 cents and we're going to credit bid our 100 cents. And Judge Gross said, no, you get to credit bid the amount that you paid for the claim. And I think that's going to send shockwaves throughout the system, and if that's codified or followed, I think that's going to have a huge impact on how cases are run.
And does that make sense? So you go, that's what you thought it was worth. That's what you paid. I mean, it's just amazing. It just seems so obvious to me, but.
But that's not how the game works.
I understand.
In answer to the second question, I hope that there's regulatory change coming, because I think that the system that we're currently operating under in Chapter 11 is broken. I think that we have moved away from the intention of the code as it was originally drafted, and it's very difficult for companies to navigate outside of, selling the company. So I think if there is to be true reorganization in this country, I think we're going to have to make some changes to the code, and the ABI has a task force that is currently mandated to review that and try to figure out what can work and what can't. But we've got to figure out how to fix it.
I think particularly in my business, in the claims administration business, I think you're going to see a tremendous amount of change in the next 3 to 5 years. We are really technology companies within. And so I'm not saying we're like Kodak, that we have, the digital photography in a vault somewhere, keeping it for another day. But I think we're all working on electronic efficiencies because, noticing and balloting by paper, by mail, it's snail mail. Sure, we make a lot of money on it, but it's not efficient, and I don't think the courts or the professionals are going to have much patience for it in the long term. So we're all working on e-noticing, e-proof of claims, just trying to do our jobs cheaper and more efficient. And there's a handful of us in this industry, and I know we're all working on it, and whoever gets there first is sort of going to win.
Well, to that point, even the M&A process is evolving. We just launched our first web-based information memorandum last week. So the way of doing things is improving and changing as well.
All right. Thanks, everyone. Thanks very much. Thanks for the panel.